Well, thank you very much for joining us up here. I think just before I hand over to our industry practitioners, I hope you just bear with me through 4 slides, which you haven't seen already, then we would like you to be aware of from PRI's perspective. So one is, how have investors been responding to the TCFD recommendations? So one measure of this is PRI's own climate risk reporting indicators. We have some of our risk reporting team sitting in the room today. And this was introduced in January this year. It's a voluntary reporting framework under the PRI reporting requirement for signatories. But it was introduced at relatively short notice, and I think what's striking is the volume of responses that we received by the end of March this year. So we thought we might get sort of 100, maybe 150 if we were lucky, but we got nearly 500 investors responding to these indicators, which have been officially approved by the TCFD Secretariat, and submitting them to the PRI. So that's an indication of who at least is thinking about soft information disclosures and prepared to report to industry bodies like ourselves. It's also interesting to note the country-by-country comparison. The UK was, in absolute terms, the largest. And this is something that Claire might also touch on when she comes on to the PACTA tool and how responses have been there. So TCFD, we're going to get into this a little bit more now. I think it might be a good point to ask a question of you in the audience. How many of you here are familiar with what the recommendations were? Let's see a show of hands. Okay, great. So I think that's most of you, but perhaps not everyone. So fortunately, Jenny's going to take you through the core recommendations. But perhaps I sort of set things up a little bit. What are the benefits for doing this? And things that we see, that we set out in a report earlier this year, is that it translates information about climate change, which we've been hearing a lot about this morning, into financial metrics. It's a means to improve risk management. It's looking at developing a global comparable framework. But it's also flexible, so it doesn't matter if you've been doing this for a couple of weeks or you've been a pioneering leader in responsible investment for 20 years. There's still an entry point for you. And it's also forward-looking, and that's a point that we're going to hear a bit more from our speakers on this panel. So in thinking about TCFD, how might you go about implementing this? So I think one thing that's quite clear is this is not a pledge that you sign on to and you're done. It's not that kind of framework. This is something that's going to take time to implement. You're essentially trying to uproot your CSR team and integrate them into your risk management team. So this is an indicative timetable of what that might look like. And as you see, we've got a 3-year process. And year 1 is thinking about, OK, what are the reasons beyond being a nice person that I might want to think about doing this? What are the commercial benefits for my organization? And then assigning responsibility within the board level and at the management level, establishing processes. And then in year 2, you can start to perhaps integrate more in risk management, identifying useful metrics, and it gradually builds. So the idea is that it builds in complexity year on year. And we can get more into this, I think, hopefully through our practical practitioners' speeches. Okay, so something else that we'd like to highlight is what are the things, the tools that you can use now that are available to help you as you might start on this journey. And so PRI has this inverted pyramid of climate scenario tools. You can see on the screen here. So there's a company level one with a carbon tracker initiative, which has been worked on by some of my colleagues a while ago. There's a transition pathway initiative, which as we're in London, I assume that many of you are familiar with at a sector level. And then there's also PACTA, which is a portfolio level tool. There are more tools available as well, and we've published a directory of other providers on our website. So if you're interested in the space, there is some information that's out there, and there are things that you can do today.
So I think that's enough from me. If I could bring in Jenny and ask her to perhaps tell us a story about your approach to TCFD and the types of things that you've had in your experience.
Mm-hmm. Okay, thank you. I'm already mic'd up, okay. So good morning, everyone. It's nice to be here. I'm Jennifer Anderson. I work at TPT Retirement Solutions, previously known as the Pensions Trust. I think that the first thing in providing you some of the insights into our experience is just useful to provide you a little bit of context about our organisation. I think it helps to set what I'm going to say into some perspective. We are a master trust scheme providing both DB and DC workplace pensions. That means that we are providing pension schemes to multiple employers. Actually, we have more than 2,500 employers that use TPT to provide pensions to members. In total, around 290,000 members, 10 billion of assets, 90% of those are focused on DB. So we are really a DB-focused organisation, but auto-enrolment has meant that our DC assets are now at around 1.2 billion, so it's becoming an increasing focus for our business. Just to quickly highlight how our assets are split. So our DB assets are split between liability matching and growth assets, around 40% on liability matching, 60% on growth assets. And we think about our growth assets in 5 categories, 5 sub-portfolios, which I've listed there: equities, illiquid, market neutral, credit and insurance. The point really to include this is that it demonstrates the range of assets that we are thinking about when we are trying to understand what climate change means for our investments. So I think there's a sort of number of tools that you can use to look at the impact it has on equities, but we have a multi-asset class portfolio. Equities account for around 25% of our growth assets. So split between the other sub-portfolios, you can see that for us to understand what climate risk means, we need to make sure we thought around a much broader range of asset classes. So focusing now a bit on what I meant to be talking around TCFD. This is the sort of onion picture that shows the 4 layers or the 4 pillars that the recommendations require organisations to think about when you're looking at the governance of climate change. TPT has actually been looking at climate change since around 2011. I would say that was driven by an enlightened trustee that was on the board and an investment consultant that was ahead of the curve on this topic. So we looked at that at an investment committee meeting in 2011. There was training provided, which has kind of led and sort of really started us on our journey to thinking about climate change. The TCFD framework is very useful for me now to describe the framework that we have in place. But I suppose the work that we've been doing at TPT really predates the TCFD by some way. The chart that or the infogram maybe is a better word, that I've put on the first slide, so talking about governance, is actually from a report that I've recently co-authored alongside Legal & General for the IIGCC, the Institutional Investors Group on Climate Change. Legal & General and TPT sponsored a report which was essentially a how-to guide for trustees in wanting to incorporate climate change into investment decision-making. This is the gap analysis chart for governance, and I thought it could be a useful way for me to talk to you about how we thought about governance at TPT. So if we look at step 1, has the board oversight been defined and agreed? At TPT, the biggest risk from climate change is obviously with our investments. So the board delegates responsibility for investment making decisions and strategy to our investment committee. That means that we have placed oversight of climate change, the policy, the beliefs, etc., with our investment committee. If you look at the questions around step 2 and step 3 and how they relate to TPT, have beliefs been defined? Has a policy been developed? We have done both of those. That goes back to sort of 2013 when we first introduced our climate change policy. That has been made public, is available on our website. It's reviewed on an annual basis by the investment committee, and that has to also be signed off by our board of trustees. This year, we've just reviewed it at the September Investment Committee meeting. The policy has been updated to incorporate our commitment to reporting in line with TCFD. It's also been updated to incorporate the fact that we're going to be focusing more on our DC assets. I would say historically, quite a lot of the focus on what we're doing on climate has been focused on DB. And then I won't go through all of the steps, but step 4, step 5, step 6, and then is there an agreement on how the management of climate change will be reported? So as an organisation, we've decided to do that using the TCFD's framework, but there is an internal reporting structure which includes dashboards and manager scoring, which is the internal way that climate change is reported through our organisation. Moving quickly on to investment strategy, so the second pillar of the TCFD recommendations. Soon after we'd introduced our climate change policy, my Chief Investment Officer and I decided that we should focus more on what climate change meant for our investment strategy and to do more of a deep dive with our investment committee. We spent a long time thinking about how we could do that. The typical investment committee agenda is jam-packed full of the kind of traditional standing agenda items. There isn't normally time to look at a topic like climate change and really think about what that means for your organisation. We decided to put this as a large part of the investment strategy away day in 2016. It was recognition I've put there as climate change is a material issue but less well understood. So we took time, we invited experts into the investment committee strategy day. We worked with our investment consultant Mercer at the time, who had developed this multi-asset tool which could look at what the impact would be and quantify the potential financial impacts on different asset classes. Very, very quickly, I'll just say the blue that you can see inside the donut chart means that there's a negative impact. So the most significant impact is a negative impact on developed market equities. The positive green bars are where there's opportunities to make more of a positive asset allocation decision. So really looking at real estate and infrastructure. We used this analysis to inform our overall investment strategy. We were at this investment strategy way day also thinking about what the risk return target should be for our investment committee for the growth portfolio, and it was an appropriate point of time to incorporate this into our asset allocation decisions. I'm not going to pretend that this kind of dominated or was the only thing that we took into account, but it was at an appropriate point in our decision making that allowed us to take this analysis into account. Moving on to the third pillar, risk management. I'd say this is still more challenging, maybe particularly for a scheme of our size where we do have limited internal resources, limited kind of portfolio management systems and technology available to us. But I would say from my experience, and I do have, I suppose, wider experience, I'm on the board of the IRGCC, so kind of look at what a whole range of other asset owners are doing on this topic. But the risk metrics, in my opinion, are still evolving. Some of the largest asset owners, particularly some of the Dutch pension schemes, are starting to build their own models, which allow them to think about what this means. At TPT, we've trialled the Mercer tool that I showed you on the last slide. We've also tried the 2 Degrees initiative tool and looked at what that means for our equity portfolios. For me, the challenges are still around how you're translating all this environmental data into risk metrics, which are presented in a way that the trustee board and the investment committee are used to seeing risk metrics. These charts, like the Mercer one, they just look very different to the way that we're presenting risk data. Particularly, I suppose we're looking at things like impact on funding values, value at risk, those types of numbers. And although we're quite familiar with scenario analysis and stress testing for our portfolio, the outcomes or the outputs of the current models don't really sort of sit very sort of easily next to the current models the current risk metrics that we're using. So that either requires an element of education or for the risk metrics to really improve, to be more sort of palatable for trustees and investment committees. The other thing I'd say is that for us, there's a cost of this analysis. So there is a cost of using the Mercer tool. And these costs obviously also make it less repeatable and less real time. So if we want to incorporate this in our regular risk reporting on a quarterly basis, then we really need to be able to run that analysis ourselves and for it to just be part of our portfolio management systems. One other thing I'd just mention quickly is around communicating the output, both internally and externally. So it takes time to communicate what that Mercer chart means and how you interpret that for the investment strategy, what are the underlying assumptions. And we'd found a similar thing for the 2 Degrees initiative tool, is how do you communicate what that means in a simple way when actually it's built on such complex data. And I think that's one of the challenges I think we face going forwards. I won't spend too long talking about metrics and targets. TPT's had its portfolios carbon footprinted a number of times. I think we're all well aware of some of the challenges with carbon footprinting as a risk metric. You can see there the output of our 2 Degrees alignment tool, which we didn't actually use the PACTA tool for this. We had this done directly by the 2 Degrees initiative in 2017. I suppose one of the other questions that comes up if you're thinking about target setting, which is one of the other requirements for asset owners, is how do you really go about setting meaningful targets? And I think maybe that's a sort of discussion point we might come back to in Q&A. The last point and the last slide in this kind of whistle-stop tour of TPT's climate experience is just to think about TCFD reporting. We have committed to report in line with the recommendations, but there are a number of questions that I have. Who is this reporting really for? At the moment, it isn't a standard requirement by the regulator. Will it become something that the risk committee that the regulators on the previous panel were talking about, that means that we have to do this as part of standard reporting? At the moment, I think it's very much just best practice. I don't think that this is something that our members are looking at, although it's very... I suppose you would like to think that members are taking notice of their pensions and how they're being invested. The reality is that there is still very little engagement from individuals in their pensions. How should we position this within our annual report and accounts? If you report properly along the TCFD requirements, you end up with quite a long, detailed report. That doesn't really fit naturally into the annual report and accounts and looks very sort of out of kilter with the amount of detail that we go into on other risk topics. So it's just thinking about how that, I suppose, evolves over time. And for me, the most important things really are about, at this stage, working collaboratively with other pension funds, so really learning from others' experiences. We've been doing that through the IRGCC, where we've also recently published a report on scenario analysis and how investors might be using scenario analysis. And also, I think the importance of partnering with your asset managers. At TPT, we're all externally managed, so essentially what my team are doing in the investment team is about asset allocation. So really partnering with our asset managers for them to be able to kind of start exploring what the downside risks are under different climate scenarios is going to be key for us to understanding this risk. So I will leave it there.
Tony, thank you very much for that. I think that was such a comprehensive overview. So, of course, think about the TCFDs having those 4 sets of recommendations. And I think what we saw there was under each of those recommendations, kind of clear case study as to what Jenny and her team had done. I think something as well that came away from me, which is also hearing from others, is the challenges in terms of stakeholders, not only internal but external, but they're also internal as well. And so how you do that and formatting the information in a way that just drops into their kind of conventional way of thinking about financial risk. I'm tempted to say stop for questions, but actually we're running a little behind schedule, and I do want to get to the other panelists. So perhaps if we have whole questions you may have for Jenny till the end. So Christine, from an investment management perspective, perhaps you can share some of your experiences on TCFD.
It'd be my pleasure to do so. I'm Christine Chow from Hermes. And some of you might have heard of Hermes before. We started out in 1983 as an internal fund manager of the BTPS. So in terms of talking to and working with asset owners, we've had a long experience in doing so, even though we earlier this year, we become majority owned by a US investor. But the culture continues. Hermes Investment Management has 33 billion pounds under management, and we don't have any specific ESG products because ESG sustainability is very much ingrained in our culture based on our background. But I'm from the engagement team, and within Hermes we have a specific engagement service that we provide to asset owners to help with engagement to address material ESG issues. So in terms of our approach, maybe I can share a little bit about the Hermes Investment Management journey. Back in 2017, we started putting together a kind of a concept paper to think about how we're going to push this internally. Even though culturally we have all been very much ESG-led, as Ed was saying, we still need to do internal engagement and give tools to people on how are we going to approach this? Can we approach the issue in a more systematic manner? So Hermes has has a few different work streams or different business product lines. We have public equities, have credit, private real estate, and infrastructure. And in all of these different businesses, we actually formed an internal working group, and we meet regularly to discuss Hermes' strategy and the different approaches that is currently in place for different businesses. And that is part of our raising awareness. This is also, this low carbon paper, which you can see in the middle, is available online and you can look into it. And in there we have highlighted 4 different strands of how we approach it. First of all is awareness of TCFD. What are the recommendations? Who is part of it? Portfolio managers, of course, need to be aware. Analysts, what are they looking at? How do we talk to each other? How do they talk to engagement team? Which, because we have been driving a lot of the advocacy work, talking to companies directly. The second strand is the integration part, which involves how do fund managers actually integrate it as maybe a premium or discount in the valuation model. Of course, different teams would have different approaches, but at least this is something that we actively discuss and push for, and we have seen evidence of portfolio managers doing that. The third part is engagement. Even though we have an engagement team of about 25, 30 people, because the engagement service is for a group of over 40 institutional investors, so not each investment product has 100% engagement coverage. So for the companies that are not already covered by engagement team, if different investment teams have set targets of how much they are going to do themselves to engage with companies for change, for reduction in carbon emissions, but also other issues on low carbon transition, so that hopefully over time all companies will be covered. And the fourth pillar is advocacy, be part of the public policy engagement discussion. So Mike Sheeran was previously in the previous panel, we have, and yourself as well, we've been to Beijing together to work with the Chinese counterparts on a mutually respectable understanding of how we are going to approach it and try to learn from each other. So that is what we've been doing since 2017. And I know that this chart looks a bit small, but you'll be glad to know that in one of the reports that Jennifer mentioned, IIGCC, you'll be able to find a copy of that process, which is a 6-step process of how we has created a climate management portfolio management tool. So as of now, we report on our decarbonization activities for about 90% of our AUM, and we measure the carbon footprint of 82% of our AUM as of August 2018. And this is going to come out in the report later this year. In terms of the process, the 6 steps, which is a circular process, it started off with assessing the emissions distribution in a portfolio. Last year, internally, we have developed a carbon tool that help us to understand where the concentration of the current carbon emissions. As Jennifer was mentioning earlier, we understand if we use a third-party tool all the time, when we enhance the frequency, it could be quite challenging. So we decided very early on, then we develop our carbon tool to measure disclosure. And then we investigate at the sector level, what are the trends, what are the public policy discussion that is going on. And an engagement team, we have different sector thought pieces, and this is how we add value into the trends. We do peer analysis, and then in the fourth step, we have a physical risk overlay. This was mentioned in the previous panel as well. Some of the physical risks. This is when engagement comes in an important way, because in some developed markets, the physical location or the physical climate risk is already well reported. But in emerging markets and some other markets, we actually have to actively engage and ask for the physical location of some of the possibly supply chain manufacturing sites. But if we have a good relationship with a company, they are able to provide it, which is really helpful because we have that physical risk overlay mapping onto that. And on the fifth stage, we look at what would be the transition opportunities with the overall emissions and also low carbon transition, as well as the existing physical risks. And then we formulate an engagement to go to the company to discuss the issue with the ultimate goal of reducing overall emissions, including like methane emissions in oil and gas, for example. There's going to be the next, well, it has been a topic, but we're now moving on to more intensive discussion because now OCGI has now come up with the methane reductions targets. So we've been along the way in that discussion. So in the next 2 pages, you will find that we have two engagement case studies. One is Sinopec is deemed to be one of the more difficult companies to reach out to. We work with CDP in Beijing. I think Ed was there as well in the first technical training. We invited the company to join, and finally last year they disclosed their absolute emissions for the first time and by different business segments. So we're very pleased with the initial. And the second one is Siam Cement. It's from Thailand. In this engagement, we actively used the TPI tool from the Grantham Institute. We brought to the company's attention where they were rated at, and then we provided an active consultation process, not in the way of charging them, but from the perspective of asset owners. And if you take a look at it on our public case studies, you will find that they have made dramatic improvements. They have committed to science-based targets, as well as specific areas of change, including specific to their cement and petrochemicals segments. So I will stop here because I know that we're running out of time. And please.
Christine, thank you very much for that. So I think if we go back to what we heard at the start of the day about this idea of having a view of the future and sort of integrating that systematically. So I think what we've just heard from Christine and then earlier from Jenny is two really interesting case studies of how that's being applied today in your market. So this whole question of how you do internal comms is an interesting one. How can you get started on this journey without having to sort of spend a fortune, a lot of time on this? And so this is where we're going to turn to Clare and Murray from 2 Degrees Investing Initiative to tell us about the PACTA climate scenario tool.
Thank you, Ed. Yeah, good afternoon, everybody. My name is Clare Murray, and I'm an analyst with 2 Degrees Investing Initiative and have been heavily involved in the development of the online climate scenario analysis tool that has been launched with the support of PRI about 3 months ago now. So the aim of this is obviously to provide a free-to-use scenario analysis tool that looks into the climate alignment of equity and corporate bond portfolios. So there's many elements to this, and as you are all aware, this is not a simple question. Underpinning this is the scenarios, which require a technological and geographical granularity that allows us to compare the holdings within your portfolio to these different scenarios, to have a look at where the companies within your portfolio, to see what transition pathway they are aligned with, and what that means for the overall portfolio. The way we do this is we look at primarily four different sectors in detail. That is the power, the coal mining, the oil and gas production, and the automotive manufacturing sectors, which are estimated to account for sort of 80 to 90% of the carbon emissions from the listed equity market. And then we do a brief analysis of the cement, steel, aviation, and shipping sectors. And what our aim is to do is to link the financial holding within your portfolio to the underlying physical asset level data, which has already been mentioned today, to come up with different metrics to look at your exposure to these sectors and to look at how this changes over a 5-year time horizon, and then look at how this compares to different benchmarks, whether this be other peers or the market, or even your portfolio, if it were to be aligned with one of these scenarios. So as I mentioned, this is based on listed equity and corporate bond portfolios at the moment, but we're also expanding this to lending portfolios through some work with developing this further with banks. So as I mentioned, the underlying feature of this is the asset level data. And this is something that we source from commercial data providers, which sort of reflects the global physical assets. So looking at individual power plants, automotive production sites, etc. So what this chart aims to show is the sort of levels of coverage we're getting. So the sort of outer box is the global benchmark, so the actual estimated production or capacity of these sectors. Then we look down to what we've actually got mapped to owners, and then we bring this down further to what we've been able to map to the financial instruments. And as you can see, that for the major sectors in this analysis, this is coverage of over 70% of global assets. So moving on to the scenario tool, and many of you actually have, I believe, have already used this tool, but we're aiming to simplify this portfolio analysis by allowing you to upload your own portfolio in a confidential manner. All we require is the ISIN value and the market value that corresponds. And then the only data of this that we keep is your email address and contact details for our own reporting. So once your portfolio has been successfully uploaded, we then allow you the opportunity to review your results in 2 different formats. One of these being a complete report, which provides about a 24-page summary of your equity and corporate bond portfolios and how they stand at a technology or a sector or technology level. While you're online, what you're also able to do is dive deeper into the graphical representation of these results and looking at the different asset classes and then looking at the different graphical results presentations that we've got for each sector and technology. But then also investigate further various parameters, whether this be the scenario that you're comparing against, or the global geography, or the geography that you're interested in exploring into more detail to isolate some of these factors. So here is just a sample of what your results could look like. This shows the trajectory of the gas power capacity within your portfolio. So aggregating the capital expenditure plans of the companies that you're invested in, and aggregating that production up to your portfolio level, and then overlaying that over the different scenarios to see how the companies that you're invested in compare to these scenarios and what sort of trajectory they are on. So looking at this concrete example, for example, we see that the production in the portfolio increases faster than what would be expected under a sustainable development scenario or even the beyond 2 degree scenario, and is tracking somewhere in the range of around 4 degrees. Given the uncertainty of what these temperature rises actually relate to. But this is a way to compare yourself then to the market and to get an understanding of what the companies that you're invested in are doing. Another option for comparison is looking out to a 5-year time horizon. And now we can see your portfolio and the breakdown within the sector as compared to the various benchmarks. So one option here is to compare against a set of peers, which at this stage is a set of funds from Morningstar, or compare against your portfolio if it were aligned with a 2 degree scenario or another scenario, or comparing to the market if it were also aligned. So this looks, for example, for the power sector, you can see the percentage of coal capacity within your power sector and how it compares to this, to the other benchmarks, or similarly looking at the renewables or other technologies. So the tool has been online for 3 months now, as I've said, and I think we can be quite happy with the results and the usage. So globally, there have been over 2,600 portfolio tests conducted, and this is definitely global. There's been over 60 different countries that reportedly have been using this tool, and pleasingly, the United Kingdom is leading the way on this. Of the sort of 600 unique institutions that have implemented this, I think the UK is at about 130 institutions that have used this. So this is something we're very pleased about. I guess the other comment to make would be that there's an option there to become part of a PRI peer group, which allows you to improve the benchmarks that you're comparing yourself against. So this is a basic tick box when you conduct a portfolio analysis tool. And we're looking that in quarter one, we will be in contact with those that have expressed interest to gather their portfolio data again to be able to do a comparative analysis. But yeah, more information on that to be coming out next year.
Thank you very much, Claire. Thank you very much, Claire. And I think we're really at the end of our panel session, unfortunately, because it would be good to get into some questions. But I think key takeaways are we're seeing how investors globally and in the UK are starting to respond to TCFD. We've heard 2 strong case studies from our panelists here, and there are tools available free to use as of now. So if you're interested in this area and you want to do more, you have options. If I could just take the clicker back, one more option you have is, yes. So we have here, Matthias. Will you please stand up, Matthias? Are you here? He's not here. Well, he is in the complex. So this is a PhD candidate from London School of Economics, and he would like 6 minutes of your time, if you could, during the course of the rest of the day. So there are surveys that you'll find just on the table outside, and this is doing a survey about how people like you are thinking about TCFD, what you're finding useful, what you'd like to see more of. So just a quick 30-second advertisement for Matthias. Otherwise, I'd like to thank all our panelists for joining us, for their excellent presentations, their insights, and all of you for your concentration over the last 100 minutes or so.